As of 10:44 a.m. Eastern Time, Plug Power, trading under the ticker PLUG, is at $2.74. It's currently down just a penny, or about 0.36% for the day. That number looks deceptively calm. It masks the chaos just under the surface, as the stock opened significantly lower at $2.60 before fighting its way back up, having already traded between a low of $2.57 and a high of $2.80 in just the first hour of the session. This isn't a stock, it's a battlefield. The immediate data hides the fact that this company's shares have rallied more than 200% over the last 6 months, pulling up from a 52-week low of just 69 cents. But it's also a stock that is down more than 80% over the last 3 years. This is the epicenter of one of the market's most violent tugs of war between a compelling narrative and a terrifying financial reality. The expectation, the story that has pulled in so much speculative interest, is that Plug Power is the future of clean energy. This is the company that is supposed to be building the end-to-end green hydrogen economy. We see the headlines. New large-scale hydrogen production plants in Georgia and Louisiana are ramping up. We see the deals in Europe. We see the analyst upgrades like H.C. Wainwright maintaining a $7 price target, or TD Cowen recently upping theirs to $4.50. The common belief is that after decades of trying, this is the moment the company finally turns the corner, that government support through tax credits will finally make hydrogen viable, and that Plug will be the main beneficiary. This narrative suggests that anyone getting in now is on the ground floor of the next great energy transformation. The reality, however, is found in the company's balance sheet, and it's a stark contrast to the optimistic story. The fundamentals are, to put it mildly, highly strained. Plug Power is not profitable. In fact, it's not even close. In its most recent reported quarter, the company posted a gross loss of over $50 million. This means it currently costs Plug Power more to manufacture and deliver its products than it actually earns from selling them. When a company has negative gross margins, profitability isn't just years away, it's potentially decades away. This is compounded by an alarming cash burn rate. The company is burning through hundreds of millions of dollars per quarter just to keep the lights on, and its cash reserves are dwindling. This creates a critical problem. To fund its operations and its ambitious expansion plans, it has to get capital from somewhere, and it's getting it from its own shareholders. The company has been aggressively diluting its investors, with total shares outstanding growing by nearly 35% in the last year alone. They recently announced an at-the-market equity program, giving them the green light to sell up to $1 billion in new stock onto the open market whenever they choose. This continuous dilution puts a constant, heavy pressure on the share price, as every new share sold makes each existing share worth less. This brings us to the most critical element of the Plug Power story right now, the short sellers. The reason this stock is so volatile is that it is one of the most heavily shorted stocks on the entire market. The fundamental reality, the cash burn, the negative margins, the dilution, forms the basis of the short thesis. The shorts are not betting against green hydrogen. They are betting that Plug Power will run out of cash and dilute itself into oblivion long before that green future ever arrives. Current data shows the short interest is massive, sitting at over 331 million shares. As a percentage of the free-floating shares, that figure is estimated to be around 30%. Some reports suggest it has been as high as 40%. This is an enormous position. The days to cover, or short interest ratio, is currently estimated at around 3.7. This means if every short seller decided to close their position at once, it would take nearly 4 full days of average trading volume for them to buy back all the shares they've borrowed. This is where retail investors come in. On forums like Reddit and X, you see a completely different conversation. Many retail traders see that 30% short interest not as a sign of fundamental weakness, but as manipulation. They see it as fuel for an imminent short squeeze. Their thesis is that if they can buy and hold enough shares, they can force the price up, triggering margin calls for the shorts. This would force the shorts to buy back those 331 million shares, creating a cascade of buying pressure that, in their view, could send the stock soaring. We see the comments online every day. One user might post 10,000 shares added, not selling, while another predicts the stock will hit $20 by January. This is directly countered by others who call it a junk company and warn that shareholders are losing everything. What's your take on that 30% short interest? Is it smart money correctly identifying the cash burn, or is it a sign of a massive squeeze waiting to happen? For investors trying to navigate this, it's important to know how to track this activity. You can find the official short interest data published by NASDAQ twice a month. This data is the most accurate, though it's delayed. For more real-time but often estimated data, investors look to financial platforms like Fintel or Ortex, which track the cost to borrow. This is the interest rate shorts must pay to borrow shares. Right now, Plug's borrow rate is actually quite low, around 3%. This is an important insight. It suggests that despite the high number of shares shorted, there are still plenty of shares available to borrow. Why? Likely because of the company's own $1 billion ATM offering and the large number of shares held by institutions. A low borrow rate means the shorts are not in a panic. They are comfortable in their positions. An actionable signal to watch for would be a sudden spike in that borrow rate, say from 3% to 30% or even over 100%. That would be a sign that the available shares to borrow are drying up and the shorts are starting to feel the pressure. Chasing a short squeeze is exceptionally risky. If the retail-driven squeeze fails, or if the short seller's thesis is proven correct by a bad earnings report, the stock has very little fundamental support to stop it from falling right back to its lows. The entire conflict is amplified by Wall Street analysts, who are just as divided as retail traders. You have Citigroup on one side with a sell rating and a price target of just 75 cents, implying the stock is almost worthless. On the other hand, you have H.C. Wainwright with a buy rating and a $7 target, implying a more than 100% gain from here. This extreme divergence of opinion is why the stock swings so wildly on any piece of news. Institutional ownership is also a mixed bag. While major firms like Vanguard and BlackRock are the largest holders, reflecting the stock's inclusion in many ETFs, other institutions have been trimming or exiting their positions, while new, more speculative funds have been jumping in. So what does Plug Power actually do? For years, its core business has been selling hydrogen fuel cell systems, primarily the GenDrive units used to power forklifts in the warehouses of major customers like Amazon and Walmart. The problem was that this was a niche, low-margin business, and Plug was reliant on buying hydrogen from third parties. The company's new strategy is to become its own supplier. It is spending billions to build green hydrogen production plants and to sell the electrolyzers, the machines that create the hydrogen, to other companies. This is the high-growth story that has captured the market's imagination. But it's also the very thing that is burning all the cash. Looking forward, the tension is only going to get tighter. Plug Power is scheduled to report its third quarter 2025 results on November 10th. This is the next major catalyst. The market is desperate to see if the company is making any progress on its gross margins. Did they improve from the disastrous negative 30+%? Is the cash burn slowing? Or will they announce they've already burned through their cash and are planning an even larger share offering? This earnings call is a binary event. Good news on margins or production could ignite the short squeeze retail investors are waiting for. Bad news could validate the short thesis and send the stock tumbling. Ultimately, the story of Plug Power is a perfect example of expectation versus reality. The expectation is a clean energy leader, fueled by new technology and government support, on the verge of crushing short sellers. The reality is a company with a deeply troubled financial model, burning cash at an unsustainable rate and funding its operations by continuously selling new stock to the public. The current $2.74